Welcome to our comprehensive guide on stock indicators. Stock indicators are mathematical calculations based on price, volume, or open interest of a security or contract. Traders use these tools to predict future price movements and make informed trading decisions. The main purpose of indicators is to identify market trends, signal entry and exit points, and confirm signals from other indicators. Stock indicators are categorized into several major types. These include trend indicators, momentum indicators, volatility indicators, volume indicators, and oscillators. Let's look at how indicators work with price charts. Indicators can generate buy and sell signals based on various conditions such as crossovers, divergences, or threshold levels. Using indicators provides several benefits for traders. They help you make informed decisions, reduce emotional trading, identify potential market reversals, and develop systematic trading strategies. In the upcoming sections, we'll explore each category of indicators in detail. Trend indicators are essential tools for identifying the direction of market movement. They work by smoothing out price data to create a clearer picture of the market's direction. Trend indicators excel in trending markets, helping traders determine both the strength and direction of market trends. Trend indicators can help identify uptrends, downtrends, and sideways markets. The most common trend indicators include moving averages, MACD, and the average directional index, or ADX. Trend indicators are particularly valuable for longer-term investment strategies, helping investors stay focused on the overall market direction rather than short-term fluctuations. Moving averages are among the most popular and powerful trend indicators used in technical analysis. A moving average calculates the average price over a specific time period, creating a smooth line that helps identify the direction of the trend while filtering out market noise. Price action in markets can be volatile and noisy, making it difficult to identify the underlying trend direction. A moving average smooths out price fluctuations, making it easier to see the underlying trend. There are two main types of moving averages: simple moving averages and exponential moving averages. A simple moving average gives equal weight to all prices in the calculation period. It's straightforward, but slower to react to price changes. An exponential moving average gives more weight to recent prices, making it more responsive to new information and price changes. Moving average crossovers are popular trading signals. Let's look at how they work. Traders typically use a shorter period moving average and a longer period moving average to identify potential trend changes. When a shorter period moving average crosses above a longer period moving average, it's considered a bullish signal, indicating a potential upward trend. Conversely, when a shorter period moving average crosses below a longer period moving average, it signals a bearish trend, suggesting a potential downward price movement. Let's review some key advantages and limitations of moving averages as technical indicators. Moving averages help simplify trend identification, filter out market noise, and can act as dynamic support or resistance levels for price action. However, they are lagging indicators that follow price rather than predict it, can generate false signals, and are less effective in sideways or choppy markets. In conclusion, moving averages are versatile tools for trend identification and trade signal generation, but are most effective when used in conjunction with other technical indicators. MACD stands for Moving Average Convergence Divergence. It's a versatile indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26-period exponential moving average from the 12-period EMA. A 9-period EMA of the MACD line acts as the signal line, and the difference between them forms the histogram. The MACD consists of three components: the MACD line, the signal line, and the histogram. The MACD line shows the difference between two EMAs, while the signal line is a 9-period EMA of the MACD. The histogram represents the difference between the MACD line and signal line, showing momentum. When the MACD line is above the signal line, the histogram is positive, indicating bullish momentum. Traders rely on several key MACD signals to make decisions. Signal line crossovers occur when the MACD line crosses above or below the signal line, indicating potential bullish or bearish movements. Centerline crossovers happen when the MACD crosses above or below the zero line, suggesting changes in the trend's direction. Divergences between price and MACD can signal potential reversals. A bullish divergence occurs when price makes lower lows while MACD makes higher lows. Let's look at a practical example of signal line crossovers. When the MACD line crosses above the signal line, it generates a bullish signal, suggesting a potential upward movement in price. Conversely, when the MACD line crosses below the signal line, it generates a bearish signal, indicating a potential downward movement. Traders often use these crossovers as entry or exit points for trades. To summarize, the MACD is a powerful indicator that combines trend and momentum analysis. It consists of three components and provides several key signals that traders use to identify potential trend changes and momentum shifts. The Average Directional Index, or ADX, is a popular technical indicator used to measure the strength of a trend. Unlike other indicators, ADX measures only the strength of the trend, not its direction. This makes it useful for identifying strong trends regardless of whether the market is moving up or down. ADX values range from 0 to 100, with higher values indicating stronger trends. ADX readings below 20 suggest a weak or non-existent trend. Markets may be moving sideways or experiencing frequent reversals. When ADX is between 20 and 25, the market is developing some trending characteristics, but the trend may not be reliable yet. ADX readings above 25 indicate a strong trend worthy of a trader's attention. Values above 50 represent an exceptionally strong trend. It's important to remember that ADX only tells you about trend strength, not direction. A high ADX value could indicate either a strong uptrend or downtrend. When ADX begins falling from high values, it can signal that the trend is weakening and may be coming to an end. ADX is typically used alongside two other indicators, the positive directional indicator, or plus DI, and the negative directional indicator, or minus DI. While ADX measures trend strength, the DI lines help determine trend direction. Plus DI measures upward price movement, shown here in green, while minus DI measures downward price movement, shown in red. The gold line represents ADX, which increases as the trend strengthens, regardless of whether plus DI or minus DI is dominant. Traders look for crossovers between the plus DI and minus DI lines to identify potential trend changes. Here, when plus DI crosses above minus DI at 0.3, it signals a possible uptrend. Conversely, when minus DI crosses above plus DI at 0.9, it suggests a potential downtrend. The reliability of these crossover signals is enhanced when ADX readings are high, indicating a strong trend. Let's look at how traders might use ADX in a practical trading scenario. Here we have a price chart with ADX and the directional indicators below it. Notice how ADX increases as the price trend strengthens. A trader might enter a long position when plus DI crosses above minus DI at 0.3 and ADX is rising above 25, confirming a strong uptrend is developing. Later, when minus DI crosses above plus DI at 0.8 and ADX begins to fall, the trader might exit the position as the uptrend weakens. When trading with ADX, it's best to confirm trend strength before entering a position. Look for directional indicator crossovers when ADX is above 25, indicating a strong trend. Consider exiting positions when ADX falls below 20, as this suggests the trend is weakening and may reverse. To summarize what we've learned about the average directional index, ADX measures the strength of a trend, not its direction. Readings above 25 indicate strong trends, while readings below 20 suggest weak or non-existent trends. ADX works best when used alongside the positive and negative directional indicators to determine trend direction, and is most effective in trending rather than ranging markets. Momentum indicators measure the rate of change in price movements. These indicators track how quickly prices are rising or falling, helping traders identify the strength of a price trend. Momentum indicators typically oscillate between fixed values, with designated levels indicating overbought or oversold conditions. Let's examine the key characteristics that make momentum indicators valuable trading tools. The most widely used momentum indicators include the Relative Strength Index, Stochastic Oscillator, and Williams Percent R. Momentum indicators provide valuable insights for trading decisions, particularly for timing market entries and exits. In summary, momentum indicators are essential tools for traders seeking to identify potential reversals and optimize their market timing. Williams Percent R is a powerful momentum indicator that helps traders identify overbought and oversold conditions in the market. Developed by Larry Williams, this indicator measures the relationship between the closing price and the high-low range over a specific time period. The formula subtracts the current closing price from the highest high, divides by the total range between highest high and lowest low, then multiplies by -100. It's typically calculated over a 14-day period. Williams Percent R ranges from 0 to -100. Values between 0 and -20 indicate overbought conditions, while values between -80 and -100 signal oversold conditions. Let's see how Williams Percent R works in practice. As the price moves up and down, the indicator oscillates between overbought and oversold levels, helping traders identify potential reversal points. Williams Percent R generates trading signals when it crosses key levels. A bullish signal occurs when the indicator moves above -80 from below, suggesting a potential upward reversal. Conversely, a bearish signal is generated when it drops below -20 from above. Williams Percent R is particularly effective in ranging markets, where price tends to oscillate between support and resistance. It helps identify potential reversals, especially when combined with other indicators for confirmation. Traders should also watch for divergences between price and the indicator, which can signal strong reversals. Williams Percent R is often compared to the stochastic oscillator due to their similar nature. However, there are key differences. Williams Percent R uses a single line ranging from 0 to -100, while the stochastic uses two lines and ranges from 0 to 100. Unlike the stochastic, Williams Percent R has no built-in smoothing mechanism. Volatility indicators measure the rate of price movement, regardless of direction. Consider a market with low volatility, where prices change gradually over time. As volatility increases, price movements become more dramatic and unpredictable. Volatility indicators help traders assess market risk and identify potential price breakouts. Volatility indicators serve several key purposes for traders. Let's explore the most common volatility indicators used by traders. Bollinger Bands use standard deviation to create channels around a moving average, expanding during high volatility and contracting during low volatility. Average true range measures the average price range over a specified time period, providing a direct measure of volatility. The VIX, often called the Fear Index, represents the market's expectation of 30-day volatility based on S&P 500 index options. Traders can use volatility indicators in several practical ways to improve their trading. First, they help set appropriate stop-loss levels based on current market volatility. They can also help identify potential breakout opportunities when volatility changes significantly. Traders can adjust their position size relative to risk, taking smaller positions in highly volatile markets. Finally, they help with timing entries and exits, especially in rapidly changing market conditions. In summary, volatility indicators are essential tools for risk management and finding trading opportunities in dynamic markets. Bollinger Bands are a powerful volatility indicator that helps traders identify potential overbought and oversold conditions. These bands consist of three components: a middle band, which is typically a 20-period simple moving average, and two outer bands placed at two standard deviations above and below the middle band. Let's visualize what Bollinger Bands look like on a price chart. The middle blue line represents the 20-period simple moving average, while the green upper band and red lower band represent two standard deviations from this average. When interpreting Bollinger Bands, prices approaching the upper band may indicate an overbought condition, potentially signaling a price reversal. Conversely, when prices approach the lower band, the market may be oversold, suggesting a potential buying opportunity. One of the most powerful signals from Bollinger Bands is the squeeze, which occurs when volatility decreases significantly. This is visible when the bands contract, often preceding a major price movement. To summarize the key points about Bollinger Bands, the bands expand during periods of high volatility and contract during periods of low volatility. The Bollinger Band squeeze often precedes significant price movements, making it a valuable pattern to identify. Remember that standard deviation is measuring how much prices are deviating from the moving average. The average true range, or ATR, is a popular volatility indicator developed by J. Wells Wilder Jr. It measures the average range of price movement over a specific time period, capturing the true price volatility. Unlike most indicators, ATR doesn't provide directional signals. It simply quantifies volatility. Higher ATR values indicate increased market volatility, while lower values suggest calmer, less volatile market conditions. To understand ATR, we first need to calculate the true range. The true range is the greatest of three measurements: current high minus current low, the absolute difference between current high and previous close, or the absolute difference between current low and previous close. The ATR is then calculated as a smoothed moving average of the true range values, typically over 14 periods. Let's visualize how ATR appears on a price chart. The price chart shows the asset's movement over time. Below, we can see the ATR indicator, which rises during periods of high volatility and falls during calmer market conditions. Notice how the ATR increases when the price makes sharp moves and decreases during consolidation periods. ATR has several practical applications for traders. One of the most common uses is setting appropriate stop-loss levels based on current market volatility. For example, a trader might enter a position here and place a stop-loss at a distance of 2 times the current ATR value. This approach ensures that the stop is wide enough to avoid being triggered by normal market noise, but tight enough to limit potential losses. Traders also use ATR to identify potential breakouts following periods of low volatility and to adjust their strategies based on changing market conditions. Let's explore some trading strategies that utilize ATR. A popular approach is the volatility breakout strategy. First, identify periods of low ATR, which often precede significant price moves. Then, enter the trade when volatility begins to expand and set your stop loss at a multiple of the ATR below your entry point. ATR is also valuable for position sizing. By using the formula risk amount divided by ATR times your chosen ATR multiple, you can calculate the appropriate number of shares to trade. Remember that ATR automatically adapts to changing market conditions, works well on higher time frames for spotting significant volatility patterns, and is most effective when combined with other indicators to confirm trade signals. Keltner channels are volatility-based bands that help traders identify trend direction and potential reversal points. Keltner channels consist of 3 components: a middle line based on an exponential moving average, with upper and lower bands placed at a distance of a multiple of the average true range. The EMA forms the middle line of the channel, while the upper and lower bands are calculated by adding and subtracting a multiple of ATR from the EMA. Unlike Bollinger Bands, which use standard deviation to measure volatility, Keltner channels use the average true range. This fundamental difference affects how the bands respond to market conditions. Keltner channels tend to be less sensitive to sudden price changes, providing a more consistent channel width. Bollinger Bands, on the other hand, expand quickly during volatile periods. Keltner channels are valuable for identifying trading opportunities based on price movement relative to the channels. Traders look for bullish signals when price breaks above the upper channel or returns to the EMA from below. Conversely, bearish signals occur when price breaks below the lower channel or returns to the EMA from above. To effectively use Keltner channels, observe channel width for volatility assessment, combine with other trend indicators for confirmation, watch for narrowing channels as potential consolidation signals, and apply them in both range-bound and trending markets. Keltner channels provide traders with a structured framework for assessing trends and volatility while identifying potential reversal points. On-balance volume, or OBV, is a momentum indicator that helps traders identify buying and selling pressure in the market. OBV is calculated by adding volume on days when the closing price is higher than the previous day and subtracting volume on days when the closing price is lower. This creates a running total that shows whether buying pressure or selling pressure is dominating the market. OBV is used to confirm price trends. When both price and OBV are rising together, it confirms a strong uptrend with increasing buying pressure. When OBV rises, it shows accumulation or buying pressure. When OBV falls, it shows distribution or selling pressure. Divergences between OBV and price can signal potential market reversals. This is one of the most powerful ways to use this indicator. A bearish divergence occurs when price makes new highs, but OBV fails to confirm those highs. This suggests weakening buying pressure despite rising prices. Conversely, a bullish divergence occurs when price makes new lows, but OBV doesn't confirm. This shows buying pressure building up despite falling prices. When using OBV in practical trading, look for specific bullish and bearish signals. Bullish signals include OBV breaking resistance before price and maintaining strong uptrends with higher lows during pullbacks. Bearish signals include OBV breaking support before price and showing weakness with lower highs during price rallies. When using OBV, remember it works best in trending markets and should be combined with other indicators for confirmation. Volume profile displays trading activity at specific price levels over a selected time period. It begins with a standard price chart that shows market movement over time. While regular volume indicators show trading activity over time, volume profile displays volume at different price levels. The point of control, or POC, represents the price level with the highest trading volume. The value area represents where a specific percentage, typically 70%, of trading activity occurred. Volume profile helps traders identify key price levels where the market might react in the future. Traders can use volume profile for making trading decisions, such as entering trades near value area boundaries or setting profit targets at the point of control. Check-in money flow, or CMF, is a volume-based indicator that measures the accumulation or distribution flow of money in a security. CMF oscillates between -1 and +1, reflecting the pressure of buying and selling in the market. When CMF is above 0, it indicates buying pressure, which is considered bullish or accumulation. When below 0, it suggests selling pressure or bearish distribution. The check-in money flow is calculated by summing the money flow volume over a specific period, typically 21 days, and dividing by the total volume during that period. The interpretation of CMF is straightforward. Values above 0 indicate buying pressure, suggesting bullish conditions. Values below 0 indicate selling pressure, suggesting bearish conditions. Traders use CMF to confirm the strength of trends and to identify potential reversals through divergence analysis. The key signals from CMF include strong positive values confirming uptrends, strong negative values confirming downtrends, and divergence with price indicating potential trend reversals. A bearish divergence occurs when price makes higher highs, but CMF makes lower highs, suggesting weakening buying pressure despite rising prices. This often precedes a trend reversal to the downside. Oscillators are specialized technical indicators that fluctuate between two extreme values. These indicators move back and forth in a range, typically between overbought and oversold zones. Oscillators serve several key functions in technical analysis. First, they help traders identify overbought and oversold conditions. They work most effectively in range-bound markets, where prices move sideways, rather than in strong trends. Oscillators can also signal potential trend reversals, especially when they diverge from price action. One major advantage is that oscillators often provide early warning signals before actual price movements occur. Oscillators are particularly effective in range-bound markets where prices move sideways between support and resistance levels. Several oscillators are commonly used by traders. These include the Relative Strength Index, or RSI, Stochastic Oscillator, MACD, Williams Percent R, and the Commodity Channel Index, or CCI. To reduce false signals, traders often use multiple oscillators together for confirmation. When different oscillators show the same signal, it increases the probability of a successful trade. Oscillators offer several advantages for traders, including early warning signals, clear overbought and oversold indicators, and effectiveness in sideways markets. However, they also have limitations. They can give false signals in trending markets, may remain in extreme zones during strong trends, and typically require confirmation from other indicators. In summary, oscillators are powerful tools when used correctly and in the appropriate market context. Understanding their strengths and limitations is key to using them effectively in your trading strategy. The Ichimoku cloud is a comprehensive indicator that provides information about support and resistance, trend direction, and momentum, all in one. Let's start with a price chart and see how the Ichimoku cloud components overlay. The Ichimoku cloud consists of 5 components. First is the Tenkan Sen, or conversion line, which is a 9-period average of the high-low range. Next is the Kijun Sen, or baseline, which is a 26-period average of the high-low range. It responds more slowly to price changes. The third component is Senko Span A, calculated as the average of Tenkan Sen and Kijun Sen, projected 26 periods into the future. The fourth component is Senko Span B, which is a 52-period average of the high-low range, also projected 26 periods into the future. The area between Senko Span A and Senko Span B forms the Ichimoku cloud, which provides dynamic support and resistance levels. The fifth component is the Chikou span, or lagging span, which is the current price shifted backward 26 periods. We'll focus on the cloud for now. Now let's look at how to interpret the Ichimoku cloud. When price is above the cloud, the trend is bullish. This indicates potential support from the cloud below. When price is below the cloud, the trend is bearish, with the cloud acting as resistance above. When price is inside the cloud, there is no clear trend. This represents uncertainty and potential consolidation. The thickness of the cloud indicates the strength of the trend. A thicker cloud represents stronger support or resistance. Another important signal is when the Tenkan Sen crosses the Kijun Sen, which can indicate a potential trend change. The Ichimoku cloud provides a complete picture of market conditions, helping traders identify trends, support and resistance levels, and potential reversal points all within a single indicator. Fibonacci retracement is based on the mathematical sequence discovered by Leonardo Fibonacci in the 13th century. The sequence begins with 1, 1, and each subsequent number is the sum of the 2 previous numbers, 1, 1, 2, 3, 5, 8, 13, 21, and so on. Fibonacci retracement uses key ratio levels derived from this sequence, including 23.6%, 38.2%, 50%, 61.8%, and 78.6%. The most important of these is the golden ratio, 61.8%, which appears throughout nature and is often considered particularly significant in financial markets. Fibonacci retracement is applied to price charts by identifying a significant price move and then drawing the retracement levels. First, identify the major price move, in this example an uptrend from the low to the high point. Then, draw the Fibonacci retracement levels from the high point to the low point. The levels represent potential support areas during a pullback. Notice how the price retraces and finds support near the 38.2% and 50% Fibonacci levels before continuing the uptrend. Traders use Fibonacci retracement levels in several practical ways to improve their trading decisions. They identify potential support and resistance levels where price may reverse. These levels help set realistic price targets for profit taking. Traders look for entry opportunities after pullbacks to key Fibonacci levels. Stop-loss orders are often placed just below key retracement levels for protection. For best results, traders combine Fibonacci levels with other indicators for confirmation. Fibonacci retracement levels demonstrate a fascinating psychological phenomenon in trading, the self-fulfilling prophecy effect. These levels work partly because many traders watch and act on these same levels. When enough traders place orders at Fibonacci levels, price tends to react at those levels, reinforcing their significance. To summarize, Fibonacci retracement provides key levels based on mathematical ratios, helping traders identify potential price reversal zones, manage risk effectively, and make more informed trading decisions. The parabolic SR, which stands for stop and reverse, is a technical indicator used to determine the direction of a trend and potential reversal points. Let's look at how this indicator appears on a price chart. The parabolic SAR appears as a series of dots placed either above or below the price bars. When the dots are below the price, it suggests an uptrend is in progress. Traders interpret this as a bullish signal. Conversely, when the dots appear above the price, it indicates a downtrend. This is interpreted as a bearish signal. A key feature of the parabolic SAR is how it signals trend reversals. When the price crosses the SAR dots, the dots flip to the opposite side of the price, indicating a potential trend change. The parabolic SAR uses an acceleration factor that determines how closely the indicator follows price. This factor starts small and increases as the trend continues, causing the SAR to accelerate and get closer to price. One of the most popular applications of the parabolic SAR is using it as a trailing stop-loss mechanism. As the price moves favorably, the SAR follows, helping traders protect their profits. When using the parabolic SAR as a stop-loss, traders typically exit the position if the price crosses the SAR. The advantage is that the stop level adjusts automatically, moving closer to price as the trend strengthens. The parabolic SAR has several strengths, including its clear trend signals and effectiveness as a trailing stop. However, it also has limitations. It can generate false signals in sideways markets and may be positioned far from price in early trend stages. In conclusion, the parabolic SAR works best in trending markets and should ideally be combined with other technical indicators for confirmation of signals. In conclusion, choosing the right stock indicators depends significantly on your trading style, time frame, and current market conditions. Different trading styles benefit from different indicators. Trend followers often rely on moving averages and MACD to identify long-term market direction. Swing traders typically prefer momentum indicators like RSI and stochastic oscillators that help identify overbought and oversold conditions. Day traders often focus on volatility indicators like Bollinger Bands and volume indicators for short-term price movements. When building your technical analysis toolkit, consider indicators from different categories, including trend, momentum, volatility, and volume. For best results, start with just 2 or 3 basic indicators that you fully understand. Take time to learn each indicator's function, calculation method, and limitations before relying on it for trading decisions. As you gain experience, gradually add more indicators to address specific aspects of your trading strategy. Be careful not to overcrowd your charts with too many indicators, as this can lead to analysis paralysis and conflicting signals. Remember that no indicator is perfect, and all have strengths and weaknesses depending on market conditions. Indicators are tools to assist your analysis, not replace it. They should inform your decisions, not make them for you. For the most comprehensive market view, combine technical analysis with fundamental analysis of the underlying asset. Finally, customize indicator settings to match your specific time frames and trading objectives for the best results.